Imagine you wake up tomorrow and the cash in your wallet is worth half of what it was yesterday. Not because you lost any of it, not because prices slowly crept up over months, but because overnight, the government printed so much new money that yours became diluted, like someone poured water into your wine glass while you were sleeping. You didn't notice it happening. You just know your glass tastes different. That scenario sounds extreme. It sounds like something that only happens in faraway countries and distant centuries and history textbooks nobody reads anymore. Except it has happened, over and over again, to some of the most powerful empires the world has ever seen. And right now, in April 2026, with gold trading around $4,400 an ounce after hitting an all-time high above $5,500 just this past January, with U.S. national debt sitting at $39 trillion as of March 2026, and with global central banks now holding more gold in their reserves than U.S. Treasuries for the first time since 1996. The pattern is becoming impossible to ignore. This is the story of paper money and the empires it destroyed. Let's start at the beginning. Not the beginning of money, that goes back thousands of years, but the beginning of paper money. Because this is a Chinese invention, and like many Chinese inventions, it was genuinely brilliant right up until it wasn't. It's the 7th century Tang Dynasty. China's merchants are growing wealthy, and hauling around chests of bronze coins across a continent-sized empire is expensive, dangerous, and slow. So merchants begin depositing their coins with wealthy families and receive paper receipts in return. Certificates that say, essentially, the holder of this note is owed this many coins. They called these jiaozi, flying money, because it was lighter than metal and moved faster than anything else. For a while, it worked beautifully. Trade expanded. Commerce flourished. The idea was elegant, paper as a representation of real wealth stored somewhere else. Then the government noticed something. If they controlled the printing of these notes, they could fund armies, build infrastructure, and fight wars, without actually having to collect taxes or mint new coins. They just had to print. By the time of the Song Dynasty, the government had taken over paper money entirely, and by the Yuan Dynasty, the Mongol rulers of China in the 13th and 14th centuries, the printing presses were working overtime. War and overspending drove the Yuan dynasty to issue paper currencies in ever greater quantities, and a new currency introduced in 1287 was allegedly valued at 5 times the old one, yet the old currency had already plummeted by roughly 80% by then. They kept issuing. They kept printing. They kept trying to decree the value of money by fiat, by royal command, rather than letting it be determined by what it could actually buy. By the time the Ming dynasty toppled the yuan in 1368, paper money had become virtually worthless, and most towns and cities had reverted to a barter economy. The most sophisticated civilization on earth. Barter, because of paper. Now, the Romans didn't have paper money, but they understood the temptation at the heart of the problem, which is this. When the state runs out of real wealth, it finds ways to fake it. Rome's version of the printing press was a metalworking shop. The denarius, Rome's silver coin, was the dollar of the ancient world. At its peak in the 1st century, it was roughly 90% pure silver. Then the wars got more expensive, the legions got larger, the emperors grew more ambitious, and the treasury grew more depleted. So they started shaving the coins, melting them down and adding copper, then adding more copper. By the reign of Emperor Gallienus in the 260s AD, the denarius was less than 2% silver, a bronze coin with a thin silver wash that rubbed off in your hand. The Roman economy faced mounting challenges as hyperinflation and a devalued currency eroded public trust and disrupted trade, exemplifying how currency system failures undermine economic stability. Merchants knew, soldiers knew, the market always knows. Prices adjusted. Traders demanded more coins for the same goods. Real wages collapsed. The empire's ability to pay its armies shrank. And when you can't pay your armies stop protecting your borders. The lesson the Romans teach us isn't really about coins, it's about confidence. Money, whether it's metal, paper, or digital, is fundamentally a collective belief system. The moment people stop believing, the mechanism breaks. And a necessary condition for hyperinflation is the use of paper money, or its equivalent, because what all of these systems have in common is that they are not constrained by physical scarcity. Jump forward to 1789. France is in revolution. The monarchy is crumbling. The new government needs money desperately to pay its debts, to fund its institutions, to demonstrate that the republic can function. So they issue the assignat, a paper currency backed theoretically by seized church lands. The idea sounds almost reasonable. You hold a note, and that note represents a claim on real French real estate. It's backed by something, except the government kept issuing more assignats than there was land, and then more still, because wars with European monarchies don't pause to wait for fiscal discipline. The earliest recorded hyperinflation occurred during the French Revolution, as the assignat hyperinflated due to distrust of paper money and fear that the unstable revolutionary government would collapse. By 1786, the assignat was worthless. The government tried land warrants as a replacement. Those collapsed too. France was eventually forced to return to metallic currency. The French case is instructive because it happened so fast. Within 7 years, a confident new republic had destroyed its own currency. 7 years. And the political consequences were catastrophic. The destabilization of the economy helped fuel the radicalization that led to the terror and ultimately to Napoleon. Hyperinflation doesn't just destroy money. It destroys institutions. It destroys trust in government. When a nation's currency fails, its people often follow it into chaos. No script about paper money and empire is complete without Weimar Germany. This is the case every economics professor returns to, the case that haunts central bankers in their sleep. Germany emerged from World War I defeated, humiliated, and broke. Its national debt had ballooned, and additional billions were owed as reparations to the Allied powers under the Versailles Treaty, payable in gold or in kind. Germany didn't have gold, so it printed marks, then it printed more marks to cover the marks it had already printed. Prices doubled within days, and paychecks became worthless before people could even spend them. Workers were famously paid twice a day so their wages didn't lose value between morning and afternoon. A wheelbarrow of cash to buy a loaf of bread. Children playing with stacks of billion-mark notes like building blocks, because they were worth less than toys. The middle class, the doctors, professors, shopkeepers, and civil servants, had their entire accumulated wealth vaporized in months, not stolen by war, not lost in a crisis they could see coming, just inflated away. Hyperinflation created desperation, corruption, and unrest, paving the way for extremist movements to rise. We know what came next. The 20th and 21st centuries proved that this isn't an ancient phenomenon. It isn't a problem that modernity has solved. Zimbabwe's government had initially implemented economic policies focused on careful budgeting after independence in 1980. By the end of the 1990s, chronic overspending had sent the economy spiraling. As confidence collapsed, investors rushed to sell the currency and the exchange rate dropped. By 2008, Zimbabwe's inflation rate reached an almost incomprehensible 89.76 trillion%. Prices were doubling every 24 hours. The central bank issued a $100 trillion note, a piece of paper that could not buy a bus ticket. Venezuela followed a similar script. Oil-rich, then oil-dependent, then fiscally reckless, then desperate. When oil prices fell, the government printed money to cover the gap. By 2018, inflation topped 1 million%. Supermarkets had empty shelves, not because there was no food in the world, but because the currency had become so unreliable that supply chains collapsed. Over 50 countries have experienced hyperinflation at some point in history, leading to their economies collapsing, triggering widespread poverty and social unrest. And in almost all cases, nearly 25 out of 29 documented hyperinflations, the cause was government budget deficits financed by currency creation. This is not a coincidence. This is a pattern. Now we arrive at the present, and this is where this history stops being comfortably distant. On a Sunday in August 1971, President Nixon interrupted a broadcast of Bonanza to announce the suspension of the dollar's convertibility into gold the moment the U.S. traded fiscal discipline for a floating exchange rate. Before that day, every dollar was theoretically redeemable for a fixed amount of gold. After that day, the dollar was backed by nothing but confidence in the United States government and economy. That confidence has been enormous and genuinely deserved for decades. The U.S. dollar as the world's reserve currency gave America what economists call an exorbitant privilege, the ability to run deficits that other countries simply could not sustain. But privilege has a way of enabling bad habits. The U.S. national debt as of March 2026 stands at $39 trillion. According to the Joint Economic Committee's March 2026 report, that debt has been growing by an average of $7.23 billion per day over the past year. The U.S. debt-to-GDP ratio is now hovering above 120%, meaning the federal government owes significantly more than the entire country produces in a single year. The market is sending signals. Gold started 2025 at about $2,600 per ounce. By January 2026, it hit an all-time high of $5,589, driven by persistent inflation above the Fed's 2% target, escalating geopolitical tensions, and mounting concern over long-term dollar stability. Even after a sharp pullback, with gold trading near $4,400 in late March 2026, major banks like BNP Paribas are projecting an average of $5,620 for the full year 2026. Gold doesn't pay dividends. It doesn't generate cash flows. Rational investors don't pile into gold unless they are worried about something. And right now, they are worried about the same thing merchants in Song Dynasty China were worried about, the same thing Weimar Germans learned too late to act on, that the paper in their hands is being quietly diluted. Global central banks have been accumulating gold at a record-breaking pace of over 1,000 tons annually. The institutions that manage the world's currencies are quietly diversifying away from paper. Every empire in this story told itself a version of the same story. We are different. Our currency is special. Our institutions are strong enough. The rules of monetary gravity don't apply to us. Song Dynasty China said it. Revolutionary France said it. Weimar Germany said it. Zimbabwe said it. Almost all hyperinflations have been caused by government budget deficits financed by currency creation. And a necessary condition is always the existence of money that can be printed without physical constraint. The technology changes, from woodblock printing presses to rotary presses to digital entries on a Federal Reserve balance sheet. But the mechanism is identical. Spend more than you have. Print the difference. Hope no one notices until it's too late. History suggests someone always notices. The question that every generation faces, and that we are facing right now, today, in 2026, is not whether paper money can be managed responsibly. It can. It has been. The question is whether this government, in this moment, with this level of political pressure, will choose the difficult path of fiscal discipline over the easy path of printing. Because every empire that chose the easy path is now a cautionary tale in a history book. And the empires that held the line, that kept their money tied to something real, something scarce, something that couldn't be conjured from nothing, those are the ones that lasted. Paper money is not inherently evil. It is a tool, but like every powerful tool, it cuts both ways. History has shown us, in blood and wheelbarrows and empty supermarkets and fallen dynasties, exactly what happens when the tool is misused. The printing press gave us the Renaissance. It also gave us the assignat. The choice, as always, is ours.